Well, John, easy markets are here. We got just tons of recommendations and we're ready to go, right?
Yeah, probably the most challenging hedging market ever since maybe 2008, which we'll talk about. We are going to talk about our specific recommendation for hedging in this market, and it has a lot to do with making small sales into a market that's rising.
Hey, keep your upside open.
Keep your upside open mostly.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we're back. And since our last episode, beans went up, 35.40 and down 35.40 and now up 35.40.
Why wouldn't it?
Why not?
The same markets that we've been dealing with. Here 1 second, there the next second, and what this was is on the not the promise even. Who knows if it's even in writing? There's supposed to be 17 billion of egg products, which could be anything. But of course, Beans thought that meant them, even though they've been told numerous times it's going to be the 25 million metric tons, and it's not going to be more. What could it be? It could be anything, and it's hard. You just get this stuff every day. They went to the meeting. It sold off hard because there was no news other than they said the soybean deal was done. Then they get home a couple days later. They said, oh, yeah, no, there's $17 billion more. Who knows what the number is or how it's going to affect the markets? I think I'm more in the camp. I'm going to wait to actually see buying before you get hyped up. Other guys felt the need to pile in. But these are the markets that were given. And then we have the Iran thing we need to talk about, which is more than a thing. It's back. He's back from China, and now that's front and center. Now, oil was convinced that NATO is going to fix this in July. That's why oil sold off today. We're still at 103. Then you also saw interest rates spiking. That's
yeah, that's a story for sure.
Yeah, and that is probably that is going to be the number one story if that continues. This is picking up where it left off about a year ago, where it was really spiking. And why this affects everything is because when you look at what's happening with fuel prices, transportation, and now interest rates, everything for producers, from you get the farmers, producers to producers of any manufactured goods, is going to see a serious spike in everything. These interest rates, this is a borrow, even short-term rates everything's been creeping up. But still, the borrowing rates, coupled with the energy prices, it's hard to think anything's going to go down initially in this. Meaning quickly rising inflation is what it looks like it's going to produce. Now, the argument is how long is that sustainable and where does this lead? Well, we kind of saw this in 2008, and that's why we'll talk about this. We're in this with with grains. Grains were greatly affected last time this happened. Now, in 2008, interest rates weren't spiking like in this fashion, but it is since 2007, the interest rates have been this high. That's 20 years ago. So this does feel, and you were just mentioning before we went on there, how this does feel like 2008. It feels like a lot of stuff's really unsustainable, but when that oil went to $150 that year with all the interest rates rising and costs going up, the economy wasn't able to handle that and completely fell apart. It started with housing and all the leverage there. So that's how it ends. But the big question is, how high can all this stuff go before that happens, or will it go? Well, I meant the cost of borrowing is going higher. And the cost of energy.
Let me call Bear Stearns quick.
Yeah, and they didn't quite make it through the last downturn, but it's going to affect the grain prices a lot. Like you're getting money flowing into commodities very easy right now. Like you get this 17 billion. You go back a couple years ago when this market was in a bad mood, the market would have said, I'm going to wait till China buys something before I even go up at all. And even after they started buying, it probably wouldn't have gone up like in 2020 when China started buying significant amounts. Where do these numbers fall? They're no better than they were like 5-6 years ago. That's where they fall. You're not going to be 20, 21, 22, and 23. I think were the big years of China. We're like 60% under that or more. So these numbers are just, they weren't bullish 5-6 years ago. And when this stuff settles down, these are regular numbers, assuming China even makes these numbers. So it's just how the perception is. They said, oh, China's going to buy all our grain, and then it just goes up a ton. They could change their minds tomorrow. And that's what makes these markets really difficult. But here's where we've been.
Well, you just said change their minds.
Yes.
Like, did they even make up their mind? Do we even know if these tweets and these promises are even coming?
Yeah, do we know
like, it's just a
coming?
Tweet. It's just a headline.
It is a headline. China doesn't generally confirm this stuff, nor will they this time. But yeah, it is generally a wait and see. When they did with like the first trade war, when the deal was finally signed, the one thing that they did is they did do purchases, but they didn't get anywhere near the phase one levels. And that's what's likely to happen this time. Even when you had a very structured contract, they weren't following it. This is much looser. This is kind of, they say, and she's, like he said, she said, and we don't even know what's real. But the market waffles from China's not going to buy anything to they're going to buy everything. There's just no in between gears in these markets. It's confusing everybody. So where do we stand in grains? We have planted fast and record pace in every direction. And now everybody's getting rains, but surrounding like the main growing areas is all drought, but not enough to affect like where we're at right now. But it could quickly creep into the West very easily to the crop producing. So yeah,
I will say we just drove down to Kansas for a buddy's graduation from KU.
Yep,
KU Law.
Yeah, that's right.
Best lawyer I know. No, he's not a lawyer yet. He's got to do the easy part, which is the bar. But anyway, so we drove down through Minnesota, South Dakota, Iowa, Nebraska, Missouri, stayed in Missouri for a bit, Kansas. Holy cow, it's dry.
Yeah.
That was the main thing you saw. Now, when we came back on Sunday in Iowa, there was standing water in fields. So they must have got a ton of rain one night.
Yeah.
But it was overall dry as how I would have described everything I saw.
And that's why the markets are calm now. It's first of all, it's too early to be dry. Secondly, everything's kind of gotten a drink. Even here, it's been very dry, but now we're getting a little bit of rain. So you can't say that this is bullish weather, but it wouldn't take much to tip it to bullish. Then you have the ongoing Iran thing that we haven't even talked about. And is it going to escalate? Is it going to de-escalate? And that's where your marketing is going to go. What makes this incredibly difficult this year is we don't know if this is going to $7 corn or this is the high. Like, first of all, you have the weather and then you have the oil price. If oil starts spiking, like clearly the grains have been following that. And they're likely to continue to follow that like they did in 2008. So that's why we've been talking about this inflation in 2008. It all ties together. This has actually happened once. So it goes up initially and it goes up a lot more than people think it can go up. And this market's certainly capable of that. But now talk about the other side. It's just as capable as having some sort of deal signed and oil coming down $15 and another couple good rains, and it's nowhere near as bullish as people think right now. Very difficult market, but understand this could have substantial upside. And the reason why I know everyone's confused out there, because every call I get, from my clients is basically a different flavor. Like one guy has corn calls on, he wants to get out. The next guy's adding corn calls. And, with confidence, like, the one guy's has a profit and I don't think it's going higher. The next guy is this could go a lot higher. I want to look at like 630 strike price, way out of the money for sold bushels and stuff like that. So you're getting every single phone call is different with a different opinion. And that's really important because you don't see this very often. You do see a lot of people read stuff on like Facebook, the Facebook groups, and kind of regurgitate like some of these stories. This one, the story is changing every day and nobody knows where any of this is going other than we just kind of had the roadmap from 2008 and we kind of seen this before to some degree. So up first, up quite sharply, and then down very, very sharply. So if it sounds like we're saying that it's going to go up and then down, that's exactly what we're saying.
Yeah.
No.
Now when?
Yeah. When is
it going to do that?
You watch oil. And that's really like, we're not going to overcomplicate this. Watch the oil price. If oil and input costs continue to rise around the world, this stuff is very likely to rise.
I would add at this point, start watching interest rates because
that's going to factor in. That's going to factor, operating notes and all that. That'll factor in decisions on what to plant even this year. When push comes to shove and you got higher interest rates coming at you, you're going to be looking for obviously cost saving measures. So how do you use all this that we're talking about to help the farm and better prices?
Wouldn't you like to know?
Yeah,
Find out next time.
And one client that's been trading forever and he knows the markets really well. He's like, all you can do is basically cash market, and that's exactly what we've been suggesting doing. And what he meant is forward contracting to some degree too. When you get to these levels that are profitable for the farm, in making incremental sales, and we've said it many times, we wanted to keep the upside open. I don't know how many times we said that, 1,000 times over the last 4 months. And the upside's open, and now there's upside. So what to do next? That's the decision for us. Our official stance on it is smart to make, or at least look at making incremental sales in a market that's rising, where you're unsure about the fundamentals, and it's be more of an inflation push. And you can look at the bean spread. The July-November bean spread, I think, is at plus 7 cents. That's really bad. That's not a sign that of a strong market. This time last year when beans weren't even bullish, it was plus 25. And that was bad. So plus 7's really bad. Well, then they're saying, well, because they think new crop's going to be bullish. Bulls are not led by the back end. They're led by the front end. It is just the perception that this could get bullish. And the foundation is very, very rocky when it's structured like this. That being said, it's still a powerful move to the upside. Corn's in the same boat. Although we took some carry out, what do we have? 25 cents in between July, December. Negative 25's absolutely horrendous for that spread.
22 today.
Yeah, negative 22. That's improved. So July's 22 cents under December. That's terrible. I mean, that does not scream tightness in the least.
So, just to clarify for our listeners, when July is under December, it means we don't want corn right now. It means don't bring us any more corn.
Yes.
You can bring it to us in December.
Yes, store your corn. We don't need it now. We'll pay, you get paid to store it. That's carry in the market. And when the market gets really frothy, what you see is the exact opposite structure. They want you to pull it forward, so they give you the best price in the front. Beans are normally structured anywhere from plus 20 to $2 over in July. Very rare for this time of year for July to be under November, which it's not so rare for corn. But for beans, it's very rare to have that happen. So it's not a good sign when the fundamentals are not. This is definitely not a supply-led market. It's almost a supply perception-led market, which is a very weak market. And that's exactly what it was in 2008 too. Oil prices are going to cause prices to go higher. We're going to buy corn. There was full carry, minus 20 between July and December all the way up. And then it collapsed to 297 from 840. So, but my point is, don't underestimate, even with these poor fundamentals, that how high this stuff could go. And I have been more on the bullish side of corn and the potential of corn over the next couple quarters. I understand there's a lot of corn, and everybody knows there's a lot of corn still, but that with this kind of demand base will dry up really quick. So back to what do you do in these markets? The reason why, like I say, the insider hasn't been kicking out all these recommendations is because we've been waiting for the market to go higher. But at the same time, if you're profitable on the farm, don't stop yourself from marketing. I think that's generally the advice we're trying to give in this market. Highly unpredictable. Sorry, we have some audio problems. You probably can hear the clicks by now. I was up for a reboot before it, but we should have done that. This is at least it's not too bad, but we do have some audio stuff going on.
Time to buy some new mics.
Yeah, new mics are on the docket here, or better put that on the list. But overall, you're dealing with a potentially explosive market, especially if you start getting that dryness to creep in. So again, we've emphasized keeping the upside open strategies. We've said this repeatedly, and it's worked really good, if you did nothing even, you know what I mean? And that's not necessarily a recommendation we make often, But this is the kind of market that's where we are at on it, is that we believe there's upside. Thus, why would you make all these recommendations to short or, to start hedging in? Now, it's a game of chicken. There's going to be at one point where we're going to have to decide to pull the trigger, as there is every year at this time of year.
Well, and what's interesting to me is that you look back at last Thursday, beans down 30 cents, 35 cents overnight. That's it. There has not been follow through on either side of these moves either.
No.
Like that was down 35 and then it consolidated, and then today or Sunday night it was up 35.
Yes.
There's no, like, unless you catch that one move, then it's just going to sit there forever. So it makes it one really tough, to time anything, and
very tough trade.
You're certainly not doing any of this with options.
No, actually selling premium has been like when you thrust down, you're selling, puts. When it goes up, you're selling calls. Now, it's been a dangerous game because any of these stories could make it continue to move that direction. But the guys that have been selling premium are the only winners here. I don't think that's going to continue to work, though, at all. I'm definitely not advocating for that.
The one thing we know is that one day that's going to change.
It will. Yeah. Selling calls and selling puts at this time of year can be a very costly venture. When it chooses a direction, especially if you're playing both sides. But that's what's been working because nothing's falling through or going nowhere. You're even seeing pretty big pullbacks in wheat. Now, wheat's another story we haven't been talking about enough. It's definitely, the supply is going to go down. We're planting less. We're building into a more bullish scenario for wheat, but there's still plenty of wheat around. That we can't forget. And also we're headed to a seasonal, it makes sense. That's when they start harvesting wheat goes down. So we're at a very sharp seasonal for wheat to go down within a week from now, or even a couple days. But you also have what's going on around the world with oil. So you got to be very careful, very nimble in these markets. I've been actually very quiet. Like I haven't had a lot of positions on, and you got to be, if you're in something like it goes two days that direction, you got to be willing to take profits. That's not good in a hedging environment where you're usually sitting on positions. There was huge rush to get short corn at $5 or near $5. I feel like most of the countryside has gotten what they want because now it's kind of stuck up here. And the main thing is, could this go a lot higher? And I get to ask that. And I think they're leading me into that question. Yes, this could go substantially higher, a lot higher than people think, for a short period of time. Now, if the fundamentals aren't bullish, it will come back down to earth. But in 08, keep going back to that, this went up significantly. And you think, well, did gold and silver go up? It did. It was trending higher without a doubt in 2007, into 2008, as all commodities. This reminds me a lot of that, what's going on, and money flows into commodities. They, you can see how all these shallow these corrections have been. 2 big days down in corn, right back up to where it fell from. Same thing in beans. We see this over and over again. So you can tell that they're still buying the dips. But now on the bear side is they've collected a substantially long position. So, you want to ride the wave with the trend. And then when these guys are getting off the ride, that's when you have to be all hedged. And that's what we hope to get to you in the days ahead. Like trying to decipher this, this riddle, the maze that we got going for us. All the while, we haven't even got to the weather markets. I mean, we're not going to talk about it because we're not there yet, but we'll be talking about the weather shifts every day. So if it wasn't hard enough, we haven't even entered the weather stuff. And again, back to why we say keep the upside open this time of year. This year is a textbook example of why. Like, you don't want to be giving up on this crop with these sort of inputs, when the price is well below the cost of production or just break even. You want to see what it can do going into June. You've had a lot of good ups, but then other guys make the argument you've had a lot of tops in May, and that's true too. That's a little misleading. If you top out May, a lot of times it comes back in June, and it gets close to the top or takes out the top. But anyway, this is the time of year. But then the script quickly changes to you better have everything hedged as well, and our audio just keeps getting worse. I think we're gonna have to wind it down early today. It is the engineer. I'm going to have to talk to the engineer.
Yeah, we'll have to talk to that engineer.
Yep. As soon as we find one. Find a quality engineer, we'll talk to him.
Send resumes to John Prisch.
Yeah, this thing just needs to be rebooted. It's been a little bit buggy.
It has been. We should have known that.
Yeah, we should have known.
That's fine. I mean, it's not like it's going to hurt to end this episode early, because what do we really have right now?
I think we're talking about...
Sum it up.
I think we're talking about very important stuff, because when I talk to guys, a lot of guys are pulling the trigger and they're locking these prices in. What happens if this stuff goes significantly higher, though? Like, they're playing defense. They're still playing defensive marketing, assuming that this market's going to be like all the others, but these numbers might be low for what's going on. What if we go back into Iran, start bombing everything? They start lobbing missiles. They start hitting critical infrastructure in the energy in these Gulf states. Like this stuff isn't going down, oil. And I have a hard time believing that grains are going to separate themselves if oil goes up significantly. So keep your eye on oil. That's really what's driving this rally. If it feels like it's over, there's a deal signed. Of course, we're going to speed up hedges. But again, incredibly difficult market, trying to do the best we can without getting guys over their head or in trouble. And again, trying to keep the upside open if possible. But it is one of the tougher markets that I've ever seen as far as hedging goes.
I agree.
It's not easy.
Thanks, John.
Yes, and we'll have a very clear sounding session next time, and hopefully we have a little more clarity on Iran. Of course, they're leaving it with the 2 or 3 days. They're going to mull it over, and that leads us right into Friday with a 3-day weekend where you wouldn't want to probably be short a bunch of stuff going into the weekend, but it is this administration, and it changes every day.
Absolutely. And I'm ordering new mics as soon as we sign up.
Yeah. Yep. These are great mics, but they're it's time to get new ones.
All right. Leave your number, John.
218-731-1578.
Thanks.
Yep.